This week, several leading central banks are set to make interest rate decisions, including those in England, Japan, and China. However, the greatest market focus is, of course, on the Fed Reserve. It's a two-day meeting kicked off today, so until the US Central Bank delivers its statement tomorrow, major forex instruments are likely to remain cautious and restrained. Political jitters are also dampening risk appetite, with the geography of the events expanding today from the impeachment of South Korea's president to Canada, where the finance minister unexpectedly resigned. However, a new official was quickly appointed to replace her. In France, there is also a new prime minister. Meanwhile, just yesterday, the Bundestag expressed a vote of no confidence in the Olaf Scholz government, paving the way for early parliamentary elections in Germany in February next year. Bloomberg experts report that Germany has been stagnating for several years and is approaching a point of no return. The decline in its GDP is driven not only by the energy crisis but also by its export situation, including its inability to compete with the Chinese auto industry. It seems that government crises are becoming a global trend, which in turn affects the markets. In such circumstances, part of the assets is constantly redirected into the US dollar. As a result, its six-currency index opened on a positive note on Tuesday. However, everyone is waiting for the US Central Bank's policy decision tomorrow. Therefore, the US dollar index is consolidating within a narrow range of 106.70 to 107.00 points. The key point of the final Fed Reserve's meeting will not be the rate announcement itself. No surprises are expected this time. According to the FEDWATCH tool, more than 85% of the market sees a 25 basis point rate cut as a done deal. Investors will shift focus to the Fed's forward guidance, which could be revised toward a slower pace of rate cuts in 2025. At the same time, the US Central Bank may choose not to pause as early as January, primarily thanks to the resilient US economy. In contrast, the European Central Bank is forced to act quickly, and this is also due to economic reasons, in particular a weak and unstable economy. For comparison, while the Eurozone Composite PMI has been struggling to approach the critical 50-point mark, its American counterpart has climbed to nearly three-year high of 56.6 points. Such a sharp divergence in economic growth derailed yet another counterattack by Euro bills. Notably, since the start of 2024, the single currency has already plunged by nearly 5% against the US dollar. Today, the euro-dollar pair retreated to the two-year low of 1.0332 notched last month. The currency pair was averted from a further decline not only by the dollar's consolidation, but also by economic reports. The business activity survey showed a modest yet notable increase in the Eurozone Composite PMI. Moreover, today, the German Economic Sentiment Index doubled to 15.7 points. Thus, as the US dollar remains in a narrow range, a short-term uptrend for the main currency pair still holds for the next 24 hours. The nearest technical support level for the instrument has now shifted to 1.0433, while the resistance zone has formed within the range of 1.0600 to 1.0610. Meanwhile, oil prices have remained virtually unchanged in the medium term. This is not only due to the anticipation of the Fed's interest rate decision, but also because investors are far more concerned about sluggish demand in China. Waning consumption indicates that Beijing's political efforts this year have so far yielded no efficient results. Following the release of reports in China today, Brent crude plunged to the lower border of the range between $73.10 and $74.20 per barrel. If the Fed Reserve lowers its fund rate for tomorrow, this will improve the outlook for the oil demand. In a bullish scenario, long positions could be relevant, targeting $75.19. Regarding the Russian ruble, its volatility in the currency market has once again increased amid news of a potential tightening of Western sanctions on Russian oil exports. Given the current complicated geopolitical situation, this high volatility could persist through January 2025. Could the Bank of Russia's meeting on December 20 calm the markets? The current key interest rate in Russia stands at 21%. Experts suggest that given soaring inflation and the ruble's volatility, the rate could be raised to 24 and 25%. In theory, a more aggressive central bank's policy in the medium term will further suppress demand for imports, thereby increasing the attractiveness of ruble-denominated assets. However, there are still a few days left before the Bank of Russia's meeting. During this time, the dollar-ruble pair is likely to trade within the range of 100 rubles to 105. So that's all for today. We keep monitoring the financial markets. Monitoring the financial market situation. Subscribe to our channel and see you online soon. But the best illustration of the current state of a market might be Bitcoin. Its price has reached a historical record of almost $107,000 per token. However, as artificial intelligence advances, it may theoretically crack any codes, potentially collapsing modern cryptography.